We're in the largest asset bubble in U.S. history, and actually the world is in the largest asset bubble in history, and it's entirely a function of all of the money that central banks have been printing.
Are you tired of overpaying for your gold, silver, and platinum bullion coins and bars? Then visit sdbullion.com today. SD Bullion was recently named the 177th fastest growing company in the United States by Inc. magazine. This is because they offer the absolute lowest prices in the industry and follow up with over-the-top customer service. So what are you waiting for? Go to sdbullion.com today and join more than 60,000 happy investors that save money on every precious metals purchase they make.
Hey everyone, this is Elijah Johnson with SilverDoctors.com with your SD Weekly Metals and Markets Wrap, and our guest today is Dave Kranzler from Investment Research Dynamics. Dave, thank you so much for joining us today.
Thanks for having me on, Elijah. The pleasure's all on this side of the internet, believe me. I enjoy coming on to this show whenever you guys want me to.
All right. Well, we really enjoy having you. Now, the first topic we can discuss is the price action today in the precious metal markets. It seems like, this week precious metals have been, slowly creeping higher, and today they spiked higher. Gold spiked above $1,300. What is your perspective with regards to today's price action?
It's interesting because I've been looking for one more push lower in the price, manipulated push lower. And the reason why I say that is that, typically you can sort of read into, on a short-term basis, which way the metals are going based on the relative size of the open interest in COMEX paper gold contracts, and also the way of the relative positioning of the banks versus the hedge funds. And although the last couple weeks have shown that the banks are covering their shorts and the hedge funds are unloading their longs, it's still at the high end. It's still kind of at an extreme where the banks are extremely net short and the hedge funds are extremely net long. Now, historically, this is usually a condition in which the banks like to drive the precious metals lower, of course, using paper to cover their shorts, and it's been a big profit-making machine for them to keep wash, rinse, and repeating that cycle. Now, there have been a couple times in the last, say, at least 10 to 12 years, I have data that goes all the way back to 2005, where the banks have been extremely net short and the price of gold kept moving higher, and ultimately they had to cover their net shorts. So is it going to be like that this time around? I don't know. What's interesting is gold spiked today. They had it pushed down to 1293 overnight, especially once the London market opened, which is usually when it occurs, when the paper takedown occurs. And it spiked up about literally just a few minutes before the retail sales report was released. And it tells me that, someone had advance information on that retail sales report, because it certainly disappointed expectations. And that's what spiked up the price of gold. Obviously, the way the algos are programmed, weak economic numbers means the Fed's going to less likely to raise interest rates, which is bullish for silver. So all of that actions occurred in the paper market. And so I don't know. I'm still expecting one more push lower on this. I don't know if they'll be able to do it, because there's an extreme amount of unanticipated physical demand coming from the Eastern Hemisphere right now, and that may prevent them from being able to push down the price of gold in the paper market. It's going to be interesting to see how this unfolds over the next few weeks.
Right, and at the same time that gold and silver spiked this morning around 8:30 a.m., the dollar index plummeted about, it went from around 93.24 to about 92.81. It's recovered significantly since then. It's back above 93. But what is your perspective on how it just plummeted this morning while gold and silver rose?
Well, again, it's the way the hedge fund algos are set up. They, when the dollar drops, they dump the dollar and they rush into paper gold. It's all electronic. It's mostly computer programmed, and it's all momentum based. So the same catalyst that spiked gold higher is what spiked the dollar down. And the primary culprit in the dollar index was the dollar yen pair. Obviously a disappointing retail sales report, and there were some other economic numbers that were disappointing, means that the Fed's less likely to cut interest rate or raise interest rates, which is dollar bearish. It's that simplistic. That's how simplistically these algos are programmed. So if you look at the charts side by side, they're inverse mirror images. So gold spikes up at the same time the dollar yen spikes down. And so again, it just shows you the degree to which computer algorithms are interfering in our markets, at least on a short-term basis. So, the dollar and gold are interrelated, and it was the same catalyst that caused one to do a waterfall and one to do a moonshot.
And what is the mining sector saying right now with regard to the precious metal markets?
Again, that's an interesting question, because on a selective basis, well, let me just answer the broader question first. In my opinion, the mining stocks are set up to go a lot higher, and they're going to be a lot higher by the end of the year. And that's because I think the whole sector, gold, silver, and the mining stocks. And the fundamental backdrop with what's going on in the economy and the financial system, that's part of it. But there's also, there's a whole dynamic going on in the Eastern Hemisphere, and it looks like they're slowly trying to reintroduce gold into the monetary system. And it's not just China and India that are accumulating gold now. It's many countries over there, and they're all part of the same geopolitical economic power block that's forming. Having said that, since gold has run from about 1290 to over 1300, the mining stocks have kind of underperformed gold in a sense in general. And I'm just looking at the Huey index or the GDX index. And what that would suggest to me is that the mining stocks don't necessarily believe this run-up in the market, the short-term run-up that we've had. And so investors are reluctant to pour a lot of money into the mining stocks. I think it's kind of like, well, let's wait and see if gold holds over 1,300 and moves higher from there. So, in the fund that I manage, we still have on a little bit of a hedge against our mining stock portfolio, and that's a week-to-week hedge is how we manage that at this point, because I want to be able to put it on as cheaply as possible and pull it off as quickly as possible. So, it's just, I think what the mining stocks are suggesting right now, and this could change on a dime, is that they kind of agree with my view that it looks like there should be one more push down, one more attack on gold in the paper gold market, because the commercial banks need to get that open interest down, and they do that by pushing the market lower and forcing the hedge funds to sell their longs, and commercial banks cover. So that's kind of the broad overview. Now having said that, our fund is net long mostly junior mining stocks. So, we're positioned for a big move higher in this market. Now there are some individual stocks, and then, there's individual stories out there that are kind of moving the other way. One of them is Seabridge Mining, which I had featured in my mining stock journal. I think it was 2 issues ago. It was the September 21st issue. And I had just gotten off a conference call with the company, and I'm expecting a pretty big upward revaluation in that stock, and I recommended it. It was at 11.40, I believe, when I recommended it to my subscribers, and that was September 21st issue. And I also recommended some call option plays, those have gone up about 300% since I recommended them, and the stock's up almost $2 from the point of the price at which I recommended it. So there's examples like that on an individual select basis where some of these stocks are moving higher despite sort of kind of a sideways to slightly up movement in the sector as a whole.
Now, I'd like to turn our focus to the stock market. Today, also, the stock market hit all-time highs. The three major indexes in the United States, the Dow, the S&P 500, and NASDAQ, all are at record highs. What do you make of what's happening right now?
It's funny because anytime any of those indices tick higher, it's an all-time high. and I love watching, especially Fox Business. I switch around the financial bubble vision networks with the mute on, mainly to watch the tickers across the bottom of the screen. But, every day you turn on Fox Business, Dow new record high, or if the Dow's down a little bit, Dow in record territory or near record high. So it's a very heavily promoted event right now, the fact that these indices keep hitting new all-time highs. And to me, we're in the largest asset bubble in U.S. history, and actually the world is in the largest asset bubble in history, and it's entirely a function of all of the money that central banks have been printing. Now, the Fed obviously hasn't printed any money for a couple years, but there's several other central banks, Japan, ECB, et cetera, even the Chinese central bank, they're printing money like crazy. And there's nowhere for this money to go except into financial assets. And I include housing markets in financial assets because housing prices are driven by the amount of debt that you can take out and the amount of debt, based on the amount of monthly payment that the buyer of the house can afford. It's not based on any sort of utilitarian value of the house or any sort of relative value. It's like, hey, I can make this payment so I can afford to take out this much debt. And just to circle back to this money printing thing, credit creation is the same exact thing. Money that is created through the issuance of debt is the same thing as printed money until that debt has to be repaid back. Well, globally, and especially here in the United States, the debt never gets paid back. Right now, we're in a period where debt at every level of society and every level of our economy keeps going higher. So until someone starts paying back that debt, it's the same thing as printed money. So you might say, oh, well, the Fed stopped printing money in October 2014. Well, guess what? A lot of other central banks have been printing money, and it's enabled the U.S. economy to keep issuing debt, the U.S. financial system to keep issuing debt. I mean, the U.S. Treasury is a perfect example. But right now, we're sitting at record levels of household debt, and that includes mortgage debt, because now the mortgage debt outstanding is higher than it was in 2008. So in my opinion, just to kind of a long-winded answer of what I make of these stock markets is that we're setting up exactly the way the markets were set up in 2008, except it's going to be 2008 on steroids. So, and I don't know when, and it's not my unique idea per se, but I think we're setting up for some type of asset crash that's going to really shock people.
Another topic I'd like to discuss is Bitcoin, because it's also kind of like the stock market. It's just been trading really crazy recently. Just yesterday, Thursday, it broke above 5,000 for the first time. What do you make of the trading action in Bitcoin right now?
Again, it's to me either I'm badly misunderstanding this idea of Bitcoin and cryptocurrencies, which very well could be the case. I'll be the first to admit that, and I'll be the first to admit that my point of view is wrong. But at this point, I fail to see how Bitcoin and these cryptocurrencies are anything more than kind of a bubble right now, that the value of them going up depends on more and more people being willing to throw money at them and chasing the price higher. And if you like, I've exchanged emails and chat room conversations all the time with some of these people, and the only reason they can give me that they're buying it is that it's going higher. And to me, that's the primary attribute of a bubble. Now, again, I don't know how many people out there remember the .com bubble in '99 and 2000, but it was the same kind of thing. There was a major research, a major company that publishes and sells research that was out saying that Bitcoin is a revolutionary new currency. So what you're telling me is that in 5,000 years of organized human history, where gold has been real money and the currency for the better part of that 5,000 years, all of a sudden now there's a revolutionary new currency. Well, that's exactly what everyone was saying in 1999 about these .coms. It's a new economy, and it's the valuations are based on clicks and eyeballs, and the more clicks and eyeballs you get, the more you're worth. Well, it doesn't generate any economic benefit. Clicks and eyeballs don't generate any economic benefit. And now they do a little bit when you sell advertising, but back then there wasn't even that component of it. And there were stocks that were worthless and ended up worthless by 2002 or the end of 2001. But these were stocks that would, go public at $5. The first trade would be at $15, and they would top out at $200 or $300. So, again, to me, that's what Bitcoin smells like. But I say that with the caveat that, I could be wrong. I don't know. Who am I to say? I'm just telling you what it looks like to me based on, observations I've made and participating in the markets since, 1985.
Definitely. And I know you recently wrote an article about how it seems like China and Russia, and this is a story that has been, going on for a long time, where it seems like they're accumulating more real money, stuff that actually has intrinsic value instead of just paper assets. They're accumulating so much gold. You were talking about how Russia and China's central banks are just accumulating so much gold, and that, in your view, they're doing this to really get ready for a new monetary system and to have their monetary systems backed by gold in the future.
Yes. An interesting report was released, I don't know, it was last week or the week before. I think it was last week. And Russia right now has been accumulating gold this year at a faster rate than China, which I found interesting because I kind of loosely read the monthly reports on how much gold the Russian central bank has been buying. I mean, they seem to be pretty open about it for whatever reason versus the U.S. Federal Reserve, which supposedly hasn't bought or sold an ounce of gold since 1971, but that's because the gold isn't in there to be sold. Just ask the Bundesbank about that. But it seems like just our little corner of the quote unquote gold bug world is aware of this, but China has been amassing just an enormous amount of physical gold. I mean, the country itself produces over 400 tons a year, and no one asks where that goes. Well, it most likely goes right into the People's Bank of China, their central bank. And Russia, their rate of accumulation on gold at the central bank has accelerated this year. India has, and I don't know what India's central bank is doing, but their population is voraciously buying gold this year. And that that amount of gold has picked up again in the past few weeks. There's other countries also now that are showing up as large buyers of gold, physical gold, their central banks. And that reminds me, because another country that is just buying an enormous amount of gold this year is Turkey. And that's, other than, again, our little corner of the world, it's going unnoticed by anyone. Like all of a sudden Turkey's buying, they're on a pace to buy something like over 300 tons of gold this year. And no one for some reason, is not making any news on Wall Street or, in the financial markets, but that's big news. That's a lot of gold. So it just seems to me that the steps that the Eastern Hemisphere is doing, and it's, it's all part of this SCO geopolitical economic bloc, the Silk Road, and it's all these Eastern Hemisphere countries that have kind of banded together to form a geopolitical and economic alliance, and there would be no reason for them to be accumulating gold like this, other than that they plan to reintroduce it into the global monetary system, and we've seen some hints of that. For instance, the article that came out, I don't know, about a month ago, that said China was looking at rolling out a gold-backed yuan-denominated oil futures contract, which is huge. And I've been told from someone who lives over in Shanghai and he thinks that China's going to roll out just a simple yuan-denominated oil futures contract at the end of this month on the Shanghai Futures Exchange, and that's a direct shot at the petrodollar, and it's a direct shot at the dollar status as the world's reserve currency. But clearly something has to change, because the global financial and monetary system, based on the U.S. controlling the reserve currency and issuing as much debt and spending as much money as it wants, isn't working. And the fact that, to circle back to the question on the Dow and the S&P, the fact that these stocks have completely dislocated from fundamental reality and keep hitting new highs is evidence that this system isn't working. I know that sounds crazy. Oh, hey, higher stock markets means things have got to be working, right? Well, yeah, as long as you're within sort of the bounds of valuations that make sense based on fundamentals. But when you have stocks like Amazon trading at 200 times earnings, it doesn't make sense, and it tells you something's wrong.
All right. Well, Dave Kranzler, thank you so much for joining us today. Before we let you go, did you want to share with the viewers where they can find you online, and any last thoughts you'd like to add? Sure.
And Elijah, thanks for having me on. You can find my website at investmentresearchdynamics.com. And on that website is information links for information about my two subscriptions that I offer, the Mining Stock Journal and the Short Sellers Journal. Believe it or not, there's a lot of stocks out there that go lower every day. My subscribers have done really well with a short that I had on General Electric. I think I put that on in January at $30 or $31. So, and I guess, if I had a parting thought, it's a quote from the quarterly investment letter that we just sent out to our investors today. Currently anyone who puts their money into the stock, bond, and housing markets in search of making money is doing nothing more than gambling recklessly on the certainty of the outcome of two highly interrelated events. One, the willingness of central banks to continue pushing stocks higher with printed money. And two, the continued participation of investors who are willing to pay more than the previous investor to make the same bet. And most long-side participants have no idea that they are doing nothing more than sitting at a giant casino table game. All right. Well, David Kranzler, once again, thank you so much for your time.